Wisniewski here, Cornerstone Advisors editor-at-large. On the show today, I speak with Laurel Taylor, the founder of Candidly, which is a fintech company focused on helping people eliminate their college debt. The platform is offered through employers as a benefit, and the list of companies offering the perk includes banks. Today on the show, we explore innovations in consumer debt, the opportunity created by the passage of policy called Secure 2.0, and the emotional side of student debt. There's a lot of shame tied to it, of course. And we also talk about the joy of accomplishments. Here's the convo. Laurel, thanks so much for joining me on the show. Money Isn't Everything. It's wonderful to have you today.
I'm thrilled to be here, Mary. Thanks for having me.
Yeah, I wanted to just cut right into it of your company's name change, because I think it's telling of, a bigger truth. So let's go from, where what the name began with to what it is now and why that was.
Love to. So when I founded the company in 2016, the name was Future Fuel. And it was really with a dual purpose of fueling the future of our economy, our market competitiveness, our ability to compete globally in terms of our human capital and the ability to fuel the future as American workers for our own financial health and wellness. And this really, the central theme is through the power of education and where we as a country want to be in terms of our ability to compete globally and what it means for employees, for workers, for Americans to increase their lifetime earnings over time through the power of education. And Future Fuel was a love-hate. Some individuals loved the name and others thought we were a biodiesel company. Mm-hmm. And so the confusion really was an opportunity to reflect further around the problem that we're solving. And then at the time, really who we had become as an organization over time and what we had learned. And what we learned was that most hardworking Americans, the 70% of us who graduate with student loan debt, have a lot of shame and feel a lot of shame around our student debt. And culturally, we have this kind of bizarre treatment where it feels as though to many Americans that the expectation is to, work and pay for your college through your summertime jobs. And the reality is that may have worked 30 or 40 years ago, but with the cost of education outstripping inflation by fourfold, that really is not pragmatic. And just as we finance a mortgage, the cost of education is the second largest liability and investment that we will be making across our lifetime. And so we wanted to change the name to really shine a light on that shame and to normalize and recognize that financing education is a part of going to school and increasing your lifetime earnings. And rather than student debt sitting outside of the financial services landscape, really acknowledge it's right at the center. And it's how the vast majority of us begin our journey in the world of financial services. And to normalize that and to move from shame into feeling empowered.
And I want to get into the shame thing because it is so important. And I think it's just coming out more and more in even financial services circles, even traditional bankers finally, saying, hey, there's a deep emotional component to this. No wonder why our budgeting tool is not working. But with the name, I mean, Candidly, like Candid is what you're saying is like an open conversation about this enormous debt.
Yeah, candidly, most American households are not able to finance college through cash, right? And candidly, it takes the average American 17 to 20 years to pay down their debt. And if you are a woman or a woman of color, it will take 24 to 28 years. And having candid conversation around what that means for the long-term implications of paying down debt and how to balance that with building wellness and wealth. Because of the very strong emotional attachment that we have to student debt, over 80% of Americans who have student debt only direct their dollars to pay down student debt. And only once 100% of that debt is paid down, do we start saving for the future. Emergency savings, retirement savings. And that was published by the MIT Edge Lab and TIAA, happens to be my alma mater and one of the partners that we serve to serve hardworking Americans at scale. And really, I founded the company because I was that person who felt shame about the amount of debt that I had, and then realized, wait a second, I'm not it's the majority. It's not the minority of those who are going to school. This is a majority issue across all ages and wages of American households.
And let's unpack that, because I think that's so important that this is this is something you experienced in a personal way, because, sounds like you felt alone. What was that moment when you're like, hey, no, it's just like maybe not as many people are talking about this, but this is a reality for me.
Yeah, so I think the reality for many, I am so data centric in how I make decisions. And because of historically it's been a bit taboo to discuss student debt or finances more broadly with your friends. There really historically hasn't been a lot of conversation around it. But when I looked at the data and saw that it was the fastest growing form of debt, second to mortgages, and then again, the study produced, by a number of organizations, that was really when I realized I wasn't alone was when I found it in the data. And that empowered me to then have a discussion and jump in to solve the problem.
And this is a nice segue to the one segment we do on the show, which is That's What You Said. And you said this on another podcast, which I think is super important. Let me make sure I'm saying it correctly. But you said, I really dislike the term student debt. It's very distracting. It is it's mom's debt, it's dad's debt, it's spousal debt, it's grandparent debt, it's everybody's debt. You're nodding your head, so I assume this is still a strong belief. But it does seem like perhaps the mainstream is not like accepting it that way. Is that how you feel?
I think we are myth busting every day. And so we, as Candidly, we exist to crush student debt and to enable hardworking Americans to go beyond debt into savings and retirement savings as a workplace benefit and or in partnership with the bank they're already doing business with, so that the bank can address and help this user population address their student debt as part of their value prop of the banking experience that they're serving their consumers or their members. And what I learned, what I see and experience on really a daily basis is the assumption around who has student debt and who is affected by student debt. And what is so powerful is when we actually look at the data across the population that's being served. So, for example, we pulled data in partnership with Fiserv across 268 banks in one of their cores that they have in the back end, one of many cores. And what we saw in the data was across these 268 banks, they had billions of dollars in student loan payments that were occurring, which was really surprising. So when we look at the scale of dollars being directed to student debt, that's a surprise. Then when we look at the age and the wage cohorts, what we see across the landscape that we serve is actually the highest outstanding balance is held by those over the age of 50.
Wow.
Because these are individuals that have Parent Plus loans or they are co-signers on a private student loan. And within the workplace, as a workplace benefit, these are executives that have $97,500 of student debt on average across a population that ranges between 21 to over 65, $17,000 in income to well over $300,000 in income. And when you really dissect the age and the wage and even departments from product management to engineering, and within those departments, who is leveraging the Candidly platform, 2/3 of debt is held by women and people of color. And so it's no surprise that our platform is heavily utilized by women and people of color because this is an issue that disproportionately impacts them. Again, of all ages and wages, as you've shared.
You mentioned you have a partnership with Fiserv. I know you have a partnership with banks. This is such a, I'd still call it a novel perk. A lot of banks, credit unions struggle to recruit young staff. I hear it all the time at trade shows. And so, this is a perk that you can be like, hey, I think here's a perfect time. I mean, tell us more about this perk. Which, yes, because it's very interesting, and your timing here is like, I would say, pretty perfect.
Well, thank you. Thank
Yeah.
you. It's
You're
great
welcome.
to, it is nice to arrive at a place where,
Yes.
you
Yes.
know,
I mean, big policy changes, and I think we should drill into them.
absolutely.
Hmm.
Yes. As a founder and CEO of a new category, you really hope and pray for a little luck along the way, because timing
Hmm.
is so important. And where we are right now. So when I started the company offering student debt, so we'll first talk about it as a workplace benefit. And as we think about community banks, credit unions, and how they're really struggling to attract and retain talent, there's one dimension of the problem that we solve. And then the second is, how do we continue to modernize the digital experience that community banks and credit unions are offering to their customers? But if we first look at workplace benefits and employee benefits, what is so thrilling about 2024 is the passage of policy called Secure 2.0, setting up every community for retirement. It was passed on December 29th of 2022, which was truly one of the most rewarding, exhilarating days of my life, which was a day that broad bipartisan support across both sides of the aisle recognized this is a major problem, and student debt is obfuscating the ability for American workers to save for the future. And so, what makes common sense? What can we do to help solve this problem? Let's allow employers to offer a retirement match based on student loan payments workers are making, and treat those student loan payments as if it were the employee's own deferral into the plan. And so it provides parity for employees who are taking advantage of their employer's retirement match. It enables those who are already investing and taking advantage of that retirement match to potentially maximize. What we see in the data are employees who are participating but not able to maximize, they have student loans. So now they can defer into the plan, but then get an employer match also on their student loan payments to maximize. And then there are the vast majority of workers who are just completely on the sidelines. And that retirement match, although it's really compelling, it also means taking away cash flow from my wallet right now for a future state that could be 20, 30, 40 years from now. So what we see in the data are that those who have student debt are very sensitive to cash flow. So even though there could be a match and it's super valuable, it's a blocker. And so now financial institutions can offer a retirement match to this population that's sidelined and missing out on that awesome value proposition that their employer is offering. So that went into effect on 1/1/24, and it's employers and FIs can offer this benefit, even getting their plan design, which we help with, as late as December 31st. So they can deploy anytime this year. They can still do it. They can still do it for open enrollment. And what we see in the data is that employers who offer a contribution in connection with student loans, when they help pay down the student debt of their employees, which is tax-free, up to $5,250 a year, an employer can actually help pay down and accelerate the pay down of student debt. We facilitate that full benefit offering. See a reduction in turnover by 76%, which is staggering. And that's also holds true in the healthcare vertical. So extreme hypermobility and burnout in these industries. And then for that retirement match, it's too new to have the data on retention, but we're expecting it to be between 40 to 76% reduction in turnover. And so all FIs can offer a benefit to their employees that's tax advantaged, that enables them to do something they're already doing, which is a retirement match, and make it available to a broader population.
Yeah, and I want to go into that point of, it's the psychological issues that are like, I need to deal with my cash flow on a day-to-day basis versus longer term. And I can go back. I was lucky in that I didn't have too much college debt, but I had a job that didn't pay much, and I lived in New York City. So I remember thinking, oh, I can't afford to put this in retirement. And I had a boss that was like, put it in retirement. I'm like, well, I don't know, And luckily, this was luckily, I think like a couple years in, it's something just automatically was happening for me, and I hadn't even realized it. So I mean, I could have. It was just one of those. It's a mental hurdle when you're like, it's very hard to pay rent and the other bills. So like you're thinking this wouldn't do well, but I'm really intrigued by this as a benefit. But Laura, have you seen like any of the corporations you're working with? Because sometimes these perks get buried, like they're just buried, and you don't you don't really know they exist unless you're really digging in with the HR person. But have you seen any really good examples of someone you partner with where you're like, yes, this is if you made this perk available, this is how you would present it to employees.
Yes. So, yes, and it's really exciting. So we are deployed across about 1,400 employers.
Wow.
Of all different sizes.
How does that feel, by the way? I mean, that's a remarkable sentence to be able to say.
Thank you. Thank you. We started with very small, serving very small employers or micro employers, then small medium business, then mid-market, then enterprise. Today, our average employer has 22,500 employees. So we're in what they call the mega jumbo ultra space.
What a name.
I know, right? Jumbo. I know, it's so great. It's incredible. And we are largely distributed by partners in the financial services, 401k, financial wellness, life insurance space. So we are an embedded finance solution where we're integrated into, for example, Empower's experience in Vanguard and several Lincoln Financial Group and One America and a number of truly Guild Education, so that as they deploy across the employers that they serve, we're a part of that offering, which makes that offering inclusive for 100% of wellness within the workplace. And so when we look at we have a proven playbook. We call it our proven playbook for communications. And one, in terms of if you build it, they will not come. That's true both for market adoption, where you go out and you make it happen and you get that momentum and you get the early adopters and you move from novelty into new category into new normal. We are in that transition from new category to new normal. 90% of the pipeline that we receive from our partners with whom we have the privilege of working, some of the firms that I just mentioned, that's like the Olympic sport of enterprise partnerships to work with these organizations. When we deploy, what we see for those receiving a contribution to help pay down their student debt, we see it like 99% adoption within the first week.
Wow.
Which means, employees, when they hear their employers offering a contribution, they will move heaven and earth to get that contribution very quickly. Very similar data on we call it a student loan retirement match, the retirement match on student loan payments. But when we look at that data more deeply, what we're seeing is a 13% lift in employee participation. So it could be, the Mary that had the conversation with the HR person who is giving that great advice of like, don't leave money on the table, take advantage of the match, get into 401k savings before an auto enroll, which sounds like was like the magic of getting you into that plan. What we're seeing is a 13% lift in employees getting into the game of retirement savings first time, which is really exciting. And then we're seeing a 27% lift in those who are maximizing. But I think the data point that is most compelling beyond first-time folks getting into plan and first-time folks are maximizing is 95% are maximizing. So they're going from zero participation into fully maximizing their benefit. And that is, when we look at the time of retirement, that's the difference of, so let's imagine that an individual receives a contribution, a retirement match from their employer for just 50%, 50, half the time they're paying down their student debt. It's $450,000 of retirement savings projected at the time of retirement, that's 4 times what boomers have today.
Wow.
From one tiny little provision in Secure 2.0 called Section 110.
It's always something obscure sounding like that, right? I think of like the Dodd 1033 for
That's right. Exactly. Oh my gosh.
I feel like the industry needs like better labels, like like
yes, I would agree with that.
something better than that.
Some random number that no one knows what it means. I agree.
Yeah. Well, Laura, I'm curious. I mean, this is more. I'm thinking more of the end consumer with this, but financial health, improving outcomes. It's such a journey. You get a little bit better, and you take a hit. You get a little bit better, take a hit. But I'm curious. You mentioned in the beginning like shame, and other things come up. And I'm curious your take on like, do you have a strong opinion on what financial education might actually work for someone who wants to improve, their financial health?
Yes.
Might not be education.
I have a very strong opinion about this. So I think where much of the industry is today is in content and calculators.
Yes, calculators. People go wild and they use them. I have to say, I was surprised by that, but
they use them. What we observe is the breakage between using them and taking action. Mm-hmm. And we're in this time of tremendous velocity of what can be done in direct to consumer experience and the kinds of innovations coming out through the use of AI. And what I'm observing is the deceleration of innovation within the B2B and B2B2C space, and a massive increase in accelerating into innovation in the direct to consumer space. What I'm seeing overall is really a belief in content and calculators, which are critical complements and components. But where the user experience is today is I have a minute or 2 minutes, make it personal, personalize it to me, and serve up the action so that I can go from understanding if I'm a banking customer, my bank has this amazing rich data on me, right? So for example, banks today are sitting on data about their customers. We could pull an assessment and say, oh, your customer base has, 500 million in student loan payments that they made over the last 2 years. We can see based on this person's income, because we can see deposits, we can see transaction level data, we can see spending level data, that this population we could save on average $353 a month by getting them into one of these 4 federal programs. We can see that this population could actually benefit because they're prime or super prime into refinancing their student loans into a lower rate. Oh, we can see that this parent just took out a Parent Plus loan at 9%, but actually the private student loan market can offer a lower cost of capital than a federal Parent Plus loan right now. And so what is so exciting about the opportunity, and it really is an opportunity that financial institutions have, the consumer doesn't have to give information first time in order to serve up a personalized opportunity for that user to benefit from a financial product. The bank is already sitting on all of that data. The question is, are they looking at the data and are they making that data actionable in a way that drives value for the user, which yes, is in high yield opportunities, but the lower hanging fruit of an immediate painkiller is help them on the debt they already have to lower the cost of that debt, to liberate savings from the liability side of the balance sheet. And then you can get that into the asset side of the balance sheet.
Yeah, and I think that is so important too, because, there's a lot of budgeting apps that are like, here's what you do, but it would be so easy for it to just say you have a negative net worth, right? Because of the debt. And of course, nobody wants to engage with that because that's really upsetting information. And you're probably really well aware of it.
Exactly.
I know. Well, what's striking you in FinTech? Are there other like innovations you're seeing going on in debt? because it's such an important area that I think has been a bit overlooked in over the years.
It has, and so I think it's such a great and interesting question because the financial services industry really is organized on the asset side of the balance sheet, where the majority of Americans are. We are at an all-time high in consumer debt and overpaying on consumer debt. The average interest rate we see in the data of the users that we serve is a credit card interest rate of like 29-30%. So right there's an opportunity to help consolidate and lower the cost of debt by taking out a personal loan, paying off the high interest credit card debt, in order to pay that debt down faster. And so there is a huge opportunity to drive value in helping Americans better manage their wallet on where they are today, and then help them make simultaneous progress on where they want to go tomorrow. Because if we're saving, let's say you save, $100 a month that previously was going to interest, that can now for the bank be interchange. It can be purchasing power. It can be that can go into a number of other proprietary financial products that financial institution offers.
I love that. I just love that because both things are so important. It's just hard to have the beginning, right?
To have the beginning. That's right. Mm-hmm.
Laura, I just have a couple questions left for you, but I wanted to go back to the beginning. We started with, your story of like, how you got into this. And I'm curious, what kind of feedback did you get at the time? I mean, here you had you can't see this audience if you're not watching the video, but there was a look. I'm going to say it wasn't great, but let's confirm that. How was the reaction to, your pitch in the early days?
So I think in the early days, and context matters, right? Because the context, when I'm pitching, there are a couple different audiences that I would be pitching. One is the customer that we're serving, and really getting feedback and learning as quickly as possible where the product market fit is and the problem that we're solving, which really for employers is offering benefits that are going to drive love and loyalty. They're going to drive the ability to acquire talent faster and hold on to them longer in a 5-generation workforce that overwhelmingly has student debt. It's also in the investor community. Creating a new category is hard. It is hard. There are a couple of factors around that, which, 1.6% ish of venture capital goes to women.
Mm-hmm.
I was a first-time founder. I am a first-time founder. I am a woman. So the odds are not great. Like the numbers are not in your favor. And when I first started the company, when we were in this period of novelty, there was a lot of skepticism around, is it real? Is this going to be offered? Will it be adopted? I believed in my heart and soul that, number one, this is how I want to spend my life, and the problem that I'm going to personally devote my life to working on and addressing this problem. But number two, I really believe that there would be policy levers that would be pulled that would incentivize employers to offer benefits that address student debt, just like 401k, just like tuition reimbursement. Those two policy levers were pulled. But it is, I call them the believers. You got to find your believers in the early days. And those are friends, they're fellow founders, they're angel investors, they're your first seed check, your first Series A check, because they have to be independent of the good opinion of others, because the good opinion of others is just a pass. Because to do something new is hard. And you got to be willing to, stick your neck out a little bit to join in that journey. So I'm just really grateful that I've had the opportunity to work with so many incredible customers, channel partners, investors who believed in the need and then saw the need in the data of who they were serving in the market opportunity, which is, we're addressing $2 trillion markets, the student debt crisis, and then debt more broadly.
What's it like? So for me, I I get so excited when I write a story for like I freelance a story, and I always wanted to publish something somewhere. I get like such a thrill that I can't find elsewhere. But I'm wondering, what's it like? What was it like for you when you got that first check? What was that feeling like?
Oh my gosh. It's such a relief, thrilling. So it's the dream. It's the founder's dream. It's not everybody has that opportunity. Not everybody gets that first seed. I mean, the data is terrible, actually, in terms of diverse founders getting a seed check, getting to a Series A, getting to a Series B, massive drop-offs in between. So it gives you hope and the feedback you need, I think, at every point in the journey where questioning the journey. And it's the opportunity to continue on in that experience.
Have you found like what's like a calming thing for you to do when you're like maybe having a wild day and you're like I gotta feel calmer if that's possible for a founder, entrepreneur?
Yeah, there are a lot of highs and lows. And the last 4 years have been very volatile in the student debt space.
Yeah.
Forgiveness, no forgiveness, forgiveness, no forgiveness. Moratorium on the on ramp. I mean, it was a moratorium that was extended 9 times over 3.5 years. That is an extreme and excessive dynamic to manage. And
I know, talk about wild on again, off again storyline with much higher stakes.
Yeah, I mean, it's. I think for me, what I have found works for me, and I think it is so different for every person and every founder. I know what works for me. I live a healthy life. I don't drink. I work out every day. Like, I have to really get grounded in the day and do everything I can to ensure that when I wake up in the morning, I'm ready for it. I'm ready for the day, and I'm ready for whatever it may bring. Uh, and just staying, rooted in that. I will confess. I'm going to out myself. This is something my team thinks is hilarious. So the certainty I need is that I'm going to have a beautiful cup of espresso in the morning.
Mm-hmm.
No matter where I am in the world, I'm going to have a beautiful cup of espresso in the morning. So I travel. I refuse to check in my luggage. I'm carry-on only. And I have a traveling espresso machine in my carry-on bag.
Hey, you know your needs, and that's important,
my little espresso cup and and it's the little things that create the delight.
Yeah, it is the little things that create the delight. And one last question for you, but before I get to it, just wanted to open up. Where can people find you? Any last impressions you want to share on, like, fintech more broadly, or student
Sure.
debt specifically?
Yes. So student debt, you got to address it. I would say, anybody listening to this, you got to address it across your employee population, and you got to address it across your customers, because if you don't, someone else will. Like, it's a top 3 requested benefit. The adoption is really exploded. And from a digital banking experience, it's low hanging fruit of where you can deliver tremendous value to your customer base at a time they're looking for guidance right now. And we've generated $1.8 billion in impact across the users that we serve, lower the monthly payment by an average of $453 a month in less than 10 minutes. I mean, what other financial services experience is going to give you like $5,000 back in your wallet on an annual basis? It's incredible. Where people can find me, I'm mostly on, in terms of social channels, LinkedIn, because that's where I find most of my customers are. Yeah. It's on LinkedIn.
I am there too, but doesn't it always feel funny to say, find me on LinkedIn? I live in LA, so people are like, please tell me you have another channel, but like, it makes the most sense.
It does. And if anybody wants to connect, sales at getcandidly.com. If we can help, serve you in any way, your audience, that's the best way to connect as well.
Well, wonderful. Laurel, thanks so much for being on the show. And before you go, the last question is, what is the photo on your phone's lock screen?
Oh my gosh. Okay. So the photo is my dog.
Yes.
and my husband, and I will show
Aw.
you my dog primarily. His
Aww.
name is Scampers because he scampers about. No, little ones did not name him. I did. So his name is
They can't steal your thunder.
and I love his name, and I stand behind it.
Yeah, good. Well, Laurel, thanks so much for being on Monies and everything. I really appreciate it. It's been a true delight to have this conversation with you today.
Thanks for having me, Mary. Really enjoyed it.
Okay, so something I learned, I too definitely want to start traveling with an espresso machine. And I also really love the idea of this perk. When employees have sizable debt, it's hard to focus on other things. And this feels like a solid retention perk. And as Laurel's data shows, those with college debt includes a much broader age range than just young adults. Up next on our show is something really close to my heart. It will examine the fintech happenings from a Detroit event. I'm in conversation with Ben Maxim, the Chief Operating Officer of the Reseda Group, and a gentleman who really follows innovations in money. In late September, it held a summit showcasing a bunch of promising financial health startups. I was there. It was the first event I've done in my home state. That means something to me, and something good. Catch you then.